Hi, folks. This is Sean Hyman from Chart of the Day, and I just want to talk to you about the carry trade is not dead. You just have to look harder to find it. And I want to show you what I mean by that by taking a look at the interest rates of various countries. You'll see them all ranked here at a site that I frequent a lot of times called tradingeconomics.com. And you'll see that they're ranked from highest to lowest. Australia and New Zealand have the real interest rates right now, 3.75% and 2.5% respectively. And then everything else is 1% or below. Even most of the countries right now are 0.25% or below, such as the United States dollar, the Swiss franc, the Canadian dollar, and the Japanese yen. Japanese yen is 0.1%, so 1/10 of 1%. And actually the US is in a range between 0 and 0.25%. So really it could be even knocked a little lower here. And that range is set up by the Fed, but they have it ranked at 0.25%. And so traditionally what you do is in a carry trade, you want to buy a higher yielding currency and sell a lower yielding currency and earn the spread or the difference between those two currencies. So if I were a buyer of the Australian dollar, 3.75%, and I were a seller of the Japanese yen, 0.10%, then that means that I would keep or earn throughout the course of a year 3.65%. Now, it may not sound like a lot, but you got to remember in the currency market you're levered, and so you're putting down about 1% of the position that you're controlling. So for roughly $1,000, you can control $100,000 worth of currency. Let's just say. Now that would be fully levered. You wouldn't want to. I wouldn't encourage somebody to be fully levered, obviously, especially in a carry trade. But that's just to show what what really is possible out there. Now it would be more wise, obviously, for somebody to have $4, $5, $6, $10,000 per $100,000 that they're controlling in the market, and still earning a ton of money, but yet still leaving a ton of usable margin there at their disposal as well. Now, a lot of people right now will tell you that the carry trade is dead, and the reason why that is because the market dynamics are not there for a traditional carry trade. And the traditional is key word. Carry trades, which are where you earn rollover interest and collect daily interest for long periods of time, it's a strategy called carry trade, and it works best when you're in sideways to upward moving financial markets. So when stocks are headed higher or at least are stable, the carry trade works good. When you're in a bear market or recession and the sky is falling, they don't work good. They unwind, and so they actually reverse. And typically, things like the Australian dollar and New Zealand dollar are great currencies to hold during those times, to be the buyer of. And typically something like the Japanese yen would be one that would be smart to be short of. So in other words, being like a buyer of the Aussie yen pair or New Zealand yen pair. However, the traditional carry trade is dead right now, and I would not argue with anybody that said that, and that's because the Japanese yen has been actually appreciating. Now, the last thing you want is a funding currency that is appreciating on you. So you want your low yielder to be sideways to falling, and your high yielding currency to be stable, sideways to upward rising. With the ideal situation being the high yielding currency that you're buying being the upward trending one, and your low yielding currency being the lower, the downward trending one. And that's not what we have right now. We have a strong yen, a fairly strong Canadian dollar, a fairly strong Swiss franc, fairly strong US dollar, and this is why people will tell you that the carry trade is dead right now. Because the traditional currencies that you would use for funding your carry trade, your low yielders, the currency is not headed in the right direction. In other words, the money that you would make in interest would be more than made up by what you would lose on the appreciation of the pair as it went against you. And I say lose as it went up against you because you would actually be short these pairs, or short these currencies rather, and long the high yielding currencies. Now, the reason why I say the traditional carry trade is dead is because the non-traditional carry trade is very much alive and well. And what is that one? It's the Euro-Aussie pair. The sentiment in the Eurozone is horrible right now. That's no secret. There's problems in the Eurozone from Greece, Portugal, Spain, on and on. Tons of debt problems. They're far out of line with the European Union's maximum parameters of 3% allowed. You know, Greece alone has almost 13% debt to GDP ratio, and on a percentage basis, and the max that's allowed is 3. So I mean it's way out of kilter. And so what you have here is the sentiment in the Eurozone is horrible, so that the euro is going down. The sentiment in Australia is actually very good right now. They've had great unemployment numbers, meaning the unemployment rate's going down. Great employment numbers, meaning employment levels are going up. And they've had several rate hikes this year. So it's kept this fundamental trend headed downward into a technical downtrend. And you can see that by this downtrend line and by the downward sloping 200 simple moving average as well. The medium-term trader can short this pair towards these high points where it meets the downtrend line and just ride it through until it dips significantly lower and then close out the position. That's what a medium-term trader can do. They're mainly going to pick up the appreciation in the pair as the pair falls, and they're short the pair while also earning some interest here and there. The true carry trader is a long-term trader that will be in something for like 6 months, a year, 2 years, that sort of thing. They can ideally short towards the downtrend line, or if they're literally going to be in it that long, they can short pretty much anywhere in here if they're, as long as they're willing to allow it to go against them for a little while and realize that it could use up some of their usable margin in the meantime as it goes against them, and they've got more than enough to account for that. But you know, imagine, if you will, you're earning the high yielding interest of the Aussie. You're only having to pay the 1% interest of the euro. You're earning the difference on your money, and you're making appreciation in the pair as it falls. So you're short the pair. You're earning 7 days interest a week over 5 days, Monday through Friday. You're in triple interest on Wednesday, and that's how you get your 7 days of interest over 5. The interest is credited at 5 p.m. Eastern Standard Time as you roll from one international trading day to the next. So this is a strategy that we'll be looking at and employing in the Currency Cross Trader service. Now, we won't be doing the long-term trade in the service, but we will be doing some of the medium-term trades. We'll be looking at some of these pairs as they set up and meet our parameters, and so we'll happen to earn some interest off of some of these as we go along the way. And so I hope you'll check out our Currency Cross Trader service. That gives you exact buys, exact sells, exact limits and stops, and weekly updates from me in great detail as well. So thanks so much for watching. Bye-bye.